Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, August 31st. Hope you guys are having a wonderful day so far. We got a lot to cover today, so we'll just kind of jump right into it in this economic calendar here. So remember, this week is about jobs numbers. So yesterday we had ADP numbers come in, and they both came in very strong from the July and August numbers came in. And now we got weekly jobless claims. And then tomorrow will be the Bureau of Labor Statistics, which will be the biggie tomorrow. So last week we had 235,000 people apply for unemployment. The forecast for this week was to be the same at 235,000, and it came in right in line at 236,000. Now, keep in mind, Bureau of Labor Statistics, the BLS, will be coming out with their number tomorrow, and that could be the big one this week. That could definitely move markets as we are approaching a September Fed meeting, FOMC meeting, which they probably won't be raising rates at that meeting, but it could be more discussion as to if they will raise it later in the year, perhaps at the December meeting. Also on hand for that same meeting would be the unwinding of their balance sheet. So that's something else. It's like $4.5 trillion. So that's that's going to be something else they're going to be looking for when that meeting comes in September. Also on the economic calendar, we got the personal income for July. So June we had no growth whatsoever. Forecast for July was supposed to grow about 4.4%, came in right in line. So obviously good to see people getting paid more. Consumer spending, back in June we had a 0.2% increase. It was supposed to go up to 0.4% in July, and it came up a little shy at 0.3%. Still not bad, but of course below expectations, so a little disappointing right there, as our GDP relies on consumer spending. Core inflation. So this is basically the personal consumption expenditure, or PCE, and then when we strip out food and inflation, we get what they call the core inflation. This is the gauge, the Fed. This is what the Fed gauges for the true inflation for the U.S. here. And as you can see, we had 0.1 across the board. So we had back in June, and then forecast for July, and then it came in at 0.1%. So basically what this brings us to is year over year, we were at 1.5%. The Fed is trying to reach 2%, and this just actually went down to 1.4%. This has been basically the low of the year. We were at 1.4, went up to 1.5, now we dipped back down to 1.4. It's been very stubborn. A lot of it is we're not seeing a lot of wage growth, which is keeping inflation low. This is another particular reason why some people don't think the Fed will raise rates. It's a good argument that Fed won't raise rates. They see the economy growing, but they're still not seeing inflation rising, and that could prohibit the Fed from raising rates, because typically the purpose of the Fed raising rates is to slow the economy down because inflation's getting out of control. But we're not having that issue right now with inflation. Inflation hasn't seemed to go up. If anything, it has moved downwards, and that's something, of course, that we don't want to ever get into deflation, go in that category. So this is something they'll probably weigh on their minds very carefully before they decide to raise rates again this year. We also got Chicago PMI. This is manufacturing in the Chicago region. So basically, it remained the same. There's no change in Chicago. So anything above 50 is considered expansion. Anything below is contraction. So as you can see, we had 58.9 across the board. And last but not least, we got the pending home sales for July. So in June, it was pretty good at 1.3%, but it dipped at 0.8%. Again, a lot of these numbers can look a little deceiving. We have more buyer demand out today than we did last year. Again, it's just at kind of alarming rate where there's just no inventory out there. Inventory seems to be shrinking more and more, and this is building up more and more demand. But we got more buyers out this year than we did last year. We just don't have the inventory to keep up with it. And of course, some of these numbers look like they're kind of suffering, like the housing market's going to crash or something, but it's actually the opposite. We just don't have the inventory to meet the supply, or we don't have the supply to meet the demand. So that's kind of what you're seeing. So just be careful when you see a lot of this media out there. They like to paint this gloom and doom picture, but in reality, it's not. So let's go ahead and take a look here at the, oops, excuse me, I jumped a little ahead there, headline news. Stock market's up. They like what we're seeing on the market. There's not a whole lot of other stuff other than small stuff, but it's not really making a huge impact because it's already made its impact, like Hurricane Harvey. Of course, Trump's tweet about North Korea the other day. Those different things. So right now it's taking its cue more from what we're seeing and kind of preparing itself for tomorrow. So you might see a little bit of movement heading up to tomorrow, getting ready for the Bureau of Labor Statistics numbers coming in. So as we mentioned, be prepared. I think personally, I think the number will be might be a hot number here. Here's the bond market, and as you can see, we're still rising up. We're still above that floor of support here, which kind of held. Again, we touched on it this morning. We're currently up about 5 basis points. Not enough to get any improvement in our rates, but again, you got to be careful here because, like I said, we got movement to go down, and when you see these, it kind of creates a little the market kind of is showing that the market's a little undecided where it's going to go, and these are definitely in the better levels we've seen in quite a while, or actually this year in 2017. We're starting to approach what we saw prior to the election, but whether we reach that or not, it's hard to tell. But one of the things in our favor is stock market typically is slower at this time of the year, September and October, so that could help out bond market. All right, so again, just be a little cautious. Short term, be cautious. Long term, if you don't need to lock in, just you could probably float it a little while. But if you need to kind of take action, like within a week or two, you might want to lock in. Be careful there. All right, folks. So that pretty much concludes it. Rates are about the same as where we left off yesterday. If you guys want to get more updates, just come over to Twitter. You can find me at Mike Bjork here, Mike Bjork, and at Twitter, and I post updates throughout the day. I hope you guys have a wonderful day. Thanks so much for watching. I look forward to seeing you guys tomorrow. Bye-bye.